In 2005, a one-eyed doctor with no formal finance training sat alone in his office and read something nobody else on Wall Street had bothered to read. Not a tip, not a rumor, not an analyst report. Mortgage contracts. Thousands of them, line by line, page by page. And what he found inside those documents was so obvious, so undeniable, that he immediately did something that Wall Street's smartest, most experienced, most well-connected investors hadn't done. He bet against the entire housing market. Goldman Sachs thought he was delusional. His own investors thought he was destroying their money. His fund bled for 2 straight years while everyone around him laughed. And then, in 2007, the entire system collapsed exactly the way he said it would. Michael Burry made $100 million personally in that trade. His investors made $725 million. And not one person called to apologize. This is not a story about a lucky trade. This is a story about what it actually costs to be right, when the entire world has decided you're wrong. Before Michael Burry was a legend, he was a medical resident at Stanford who quit his neurology program at 2 a.m. one night to start a hedge fund. Not because he had a plan, because he couldn't stop thinking about markets. Since 1996, Burry had been posting stock analysis on internet forums under his own name, not anonymously, not hiding behind a screen name. His real name attached to detailed, meticulous breakdowns of undervalued companies. And people noticed. Joel Greenblatt, one of the most respected investors in the world, read Burry's blog posts and wired him $1 million to start Scion Capital. No pitch deck, no meeting, just the writing. That is how good Burry's thinking was. In 2001, when the S&P 500 fell 12%, Scion Capital returned 55%. Not because Burry got lucky, because he had spent years developing a discipline that almost nobody else practiced. He read everything, the actual filings, the footnotes, the fine print. He didn't have relationships on Wall Street. He didn't have access to the right golf courses or the right dinners. He had one functional eye, a diagnosis of Asperger's syndrome he gave himself after reading about it, and an obsessive ability to sit alone in a room and read documents that everyone else had decided weren't worth reading. By 2004, he had built Scion into a fund managing hundreds of millions of dollars. And then, he found something in the mortgage market that changed everything. Here is what the entire financial system looked like in 2004 and 2005. Housing prices were rising every year. Banks were lending money to anyone who asked. Mortgages were being handed out with no income verification, no down payments, with teaser interest rates that would reset dramatically higher in 2 to 3 years. And nobody cared, because house prices always go up. That was the assumption baked into every model, every rating, every decision. Burry started reading the actual mortgage contracts inside these securities, not the ratings, not the summaries, the contracts themselves. What he found was that millions of American homeowners had been given loans they could afford right now, but only because the interest rate was artificially low for the first 2 years. When those rates reset in 2007, the monthly payments would jump by hundreds of dollars for people who had borrowed at the absolute limit of what they could pay. The math was not complicated. These loans would default massively in 2007. The entire system had been built on the assumption that housing prices would keep rising fast enough to bail everyone out before the resets hit, and Burry could see, clearly, quantifiably in the actual documents, that the math did not work. He was not guessing, he was not speculating, he had read what nobody else had read, and the answer was right there. So he did something that had never been done before. He called Goldman Sachs and asked them to create a financial instrument that would let him bet against the mortgage market, a credit default swap on mortgage bonds. Goldman Sachs took the meeting because they thought it was free money. They were certain the housing market was safe. They were happy to take the other side of the trade. They created the instrument. Burry bought it. And then he waited. Here is the part of the Michael Burry story that gets skipped in every highlight reel. From 2005 to 2007, the 2 years between when Burry placed his bet and when the market finally collapsed, he lost. Every single month, Burry had to pay premiums on the credit default swaps he held. Think of it like insurance. Every month you pay the premium and nothing happens. The policy costs you money. Burry was paying roughly $100 million in total premiums over those 2 years, month after month, while the housing market continued rising and his positions showed nothing but losses on paper. His fund was down over 17% in 2006, a fund that had never significantly lost money before. And his investors lost their minds. They sent hostile letters, they demanded their money back, they threatened lawsuits. Some of them actually called to accuse Burry of gambling with their capital and demanded he close the positions immediately. He was so overwhelmed by the pressure that he closed the Hong Kong office, cut staff salaries, and had to seriously consider liquidating the entire fund in late 2006, which would have forced him to sell his positions at exactly the wrong moment, destroying years of correct analysis for nothing. Now stop and think about that for a second. He had done the work. He had read what nobody else had read. He was right. And the people who had trusted him with their money were so convinced he was wrong that they nearly forced him to surrender the most correct trade in financial history. This is the psychological mechanic that destroys most people who are right too early. Being early and being wrong feel identical from the outside. They produce the same graphs, the same losses, the same pressure, the same social consequences. The only difference is time. And almost nobody can hold a correct position through 2 years of looking wrong, being mocked, and watching the people around them demand you stop. Burry held, not because he was indifferent to the pressure. He later described those years as among the most painful of his life. He had stress-related health issues, his marriage was strained, he was fighting legal threats while simultaneously managing a fund that was bleeding on paper. He held because the math had not changed. Not a single piece of the analysis he had done in 2004 had been proven wrong. The rates were still going to reset. The borrowers were still going to default. The timeline was 2007. The market being wrong about him did not make him wrong about the market. In early 2007, the first cracks appeared. Subprime mortgage defaults started ticking up, then surging. The bonds Burry had been betting against began losing value. His credit default swaps began paying out. And then the entire structure collapsed. The housing market, the mortgage bond market, and eventually the global financial system came apart almost exactly when Burry had said they would, in the way he had said they would, for the reasons he had identified in 2004 from reading documents in a small office in California, while Wall Street partied. Scion Capital's returns from November 2000 through the end of the trade in 2008? 489%. The S&P 500 over the same period? Less than 3%. Burry personally made $100 million. His investors made $725 million. And when it was over, when the greatest financial crisis since the Great Depression had played out exactly as this one man had predicted years in advance, nobody called to apologize. Not his investors who had threatened to sue him, not the banks who had laughed at him, not the regulators who had dismissed the warnings. Nobody. Burry later wrote a piece in the New York Times titled, "I Saw the Crisis Coming. Why Didn't the Fed?" The answer, which he understood better than anyone, was not incompetence. It was something more dangerous than incompetence. It was consensus. Here is the psychological mechanic that allowed the 2008 crisis to happen, and that allows every major financial bubble to happen. Humans are social animals. We don't just compare our possessions to those around us, we compare our beliefs. And when a belief is held by enough powerful people, when it's been true for long enough, when enough careers have been built on it, disagreeing with it becomes not just financially risky, but socially dangerous. In the mid-2000s, the belief that housing prices always rise had been true for so long, and so many people had so much invested in it remaining true, that challenging it meant challenging the entire structure of the financial world. Nobody wanted to be the person who said it, not because the math was unclear, because the social cost was too high. This is called herding behavior, and it doesn't happen because people are stupid. It happens because in almost every professional environment, being wrong with the crowd is survivable. Being wrong alone destroys you. Burry could only do what he did because he was, by nature and by diagnosis, someone who was never really part of the crowd to begin with. His Asperger's, the same trait that made social environments difficult for him his entire life, turned out to be the exact cognitive profile that the trade required. He was not interested in what people thought. He was interested in what was true. Those are not the same thing, and in financial markets, they are frequently in direct opposition. The greatest trade in modern financial history was executed by a man who was constitutionally incapable of being swayed by what everyone around him believed. Here is why this story is not just history. In late 2025, Michael Burry came back. After years of relative silence, he returned to social media and disclosed massive short positions against NVIDIA and Palantir, two of the most beloved stocks in the current AI boom. He posted one sentence: "Sometimes we see bubbles. Sometimes there is something to do about it. Sometimes the only winning move is not to play." The financial world reacted exactly the same way it reacted in 2005. Palantir's CEO called the bet crazy. Wall Street analysts dismissed it. Retail investors mocked it online. Whether Burry is right this time, nobody knows yet. He has made predictions that didn't land. He has been early before and exhausted his investors' patience. But the pattern is what matters. Every generation produces a version of this story. Someone who reads what others won't read, sees what others refuse to see, and holds a position while the crowd ridicules them, right up until they don't. The lesson is not bet against the market. Most people who do that lose everything. The lesson is about the cost of consensus thinking. When everyone in a room agrees on something financial, when the trade feels obvious, when the returns feel guaranteed, when questioning the premise makes you sound foolish, that is precisely the moment that deserves the most scrutiny. Not because the crowd is always wrong, but because the crowd being right requires you to ask one question nobody wants to ask. What have I not read? Burry's entire edge was not intelligence. It was not connections. It wasn't even courage, though he had that too. It was the willingness to sit alone in a room and read the documents nobody else had bothered to read. The answer was in there the whole time. It always is.